Hello and welcome back, guys. So some people actually have asked me to take a look at potential short squeeze stocks, and one of these right now is Fubo. We can kind of see it here in our tool, in pretty much our stock analysis tool, that Fubo is actually having a lot of stock tweets impressions, many likes, many posts, so it's being talked a lot about today. So what is happening is what we're going to examine next. We're first going to take a look at the metrics tab, and you will kind of see that the stock is actually up 50% in terms of its price today, and overall it has an about 30% short interest is what I was looking at earlier. And that means that it's actually short squeezing pretty much as we are talking right now, as I'm making this video. You can kind of take a look at the stock news here and see why Fubo stock jumped early Tuesday, and these three stocks have plenty of room to run and things of that sort. So what happened here with Fubo? Is there a reason, or is it just a short squeeze? As you'll kind of see here, this article is a little bit generic here. The company is due to update investors on its growth outlook this afternoon. Fubo TV is burning through cash, but executives are aiming to improve the trend. So what happened? So you'll see here that investors in sports streaming specialist Fubo TV were beating the market on Tuesday, as the stock has soared 39%, and right now it's actually up 50%, as you are seeing. The rally ahead of a company investor day presentation erased just a small portion of the losses that shareholders have seen so far this year, and this is actually very important as well. If you go back to the stock and if we take a look at our metrics page here, you will see that since its last year, pretty much the stock has lost a large majority of its price, and so 51% right now is basically nothing. Again, if we take a look at the 3-year chart, take a look at this one. It has been plummeting like there's no tomorrow. So it's it's actually up 50% today. It barely has moved compared to what it has been doing in the past, where it was like 52 over here. Okay, so let's go back. So what? Fubo TV executives are set to make a presentation at the company's annual investor day. As you'll see here, meeting on Tuesday afternoon is what we're seeing right now. And as you can kind of understand, as you can kind of guess, you will see here that management isn't projecting positive free cash flow until 2025, actually, in fact. But as you can understand, this currently, right now, as I'm making this video, is basically on a short squeeze. And it's not really the company itself, it's the fact that it has been massively squeezed because a lot of shorts came in, that you are looking at this type of insane increase today, which could be temporary or could last a little bit. So I did want to make a video so that we address whether the company is actually, generally speaking, a buy, or it's just a trading target potentially, so that you can make some money in the short term. So if you take a look at the P ratio of the company, minus 245, the company is losing money. Hand over fist. As you will see, it's just getting a little bit better, but still losing money. And the same thing with the price to free cash flow ratio. Again, it used to be very high, but now it's in negative territory, meaning that the company is actually losing money. And take a look at this outstanding shares count. I mean, it's absolutely insane how much the company has been diluting shareholders here. 4,000% in terms of increase in stock amount of outstanding shares. Pretty much issuing shares like crazy. This is really not a company to be investing in for the long run, no doubt about this one. And in terms of the total liability to free cash flow, again negative, because the company is not making any free cash flow. Now you will see that the revenue growth of the company is massively increased, because at some point the company wasn't doing any really. It basically started from zero, and this is why you are looking at this insane increase. But I wouldn't pay too much attention to this one, especially since the net income is going down and the free cash flow is also going down here, again getting in negative territory, with the total equity going up because of the outstanding shares, as you can understand, printing massive amounts of shares, investors buying, and so the company is making some extra equity here. Now, of course, the margins of the company are negative, returns are negative. This is looking like a very, very bad company to invest in, is the thing. Now, let's take a little bit of a look at the income statement. And you will see that, the company had almost no revenue here, and at some point it reached 638 million. And still, the net income is negative, in negative territory. Minus 382 million is what they did lately. And in terms of their balance sheet, you will see here that the total liabilities are sitting at about 700 million, while their total equity is at about the same amount, 671 million. With the total debt of the company being at 363, almost half of the total equity here. And additional paid in capital is how the company pretty much funds themselves, because they're not really making any money from operations. They're just making money from their shareholders, and this is, as you understand, super dangerous here. In terms of their cash flow, it has been increasing pretty much, actually has been declining in terms of the net income of the company, and in terms of the operating cash flow, again declining. It's a declining story here. And if you take a look at the free cash flow, it's in the negative. It started negative and then continued even more in the negative, even more in negative territory. So as you can understand, this is a meme play right now. It's just not a company to be investing in. It's a company to trade for a short squeeze potentially. You may be making some money out of this one, but I definitely wouldn't be buying and holding this one for the long run. This doesn't look good at all, as you can understand. And we can always take a little bit of a look at our stock evaluation tool just to verify that. And the numbers are absolutely very, very out of the ordinary here. As you can understand, the revenue growth has been tremendous because, again, the company started with 0 pretty much. And so for the revenue growth, let's just say that I go super high, 30, 40, and 50, which is absolutely insane for a company of this sort. But it could happen. Let's just say it does happen. But the margins have been negative all over the place. Take a look at this one. And so what we can do here is just go a little bit marginal in terms of what the company can be making. And again, remember, I'm using tremendous revenue growth here, which is more than likely never going to happen. But let's just say that this is going to be the case from now on for the next 5 years. And so 80 and 90% and 100 is going to be my free cash flow margin that I'm going to be using for this one. The annual return, I'm going to go for 15% because obviously this is way, way risky. So let's just go for 15%. Whoops, if I could type. Let's just go for 15% here and hit calculate. So what are we getting out of this one? So for these kinds of insane revenue growth, we can see that the company, if on our medium and high estimates, it could be a buy. Of course, these are extremely aggressive here, the company increasing their revenue growth, the revenue every 50% every year. A more normal one would probably be maybe like 10, maybe 13 and 16. But remember, the company has been losing money. They are not making money. So this is also super extreme here, this 3, 5, and 7%. And again, if we hit calculate with this one, we are still rather close to the current price. But remember, again, net income margin here that we actually calculate for is positive, and this is not the case with the company right now because it's not really making money. It's actually losing money, tons of money. Again, remember, if we go back to our income statement, you will see that the net income of the company has been in negative territory pretty much every year apart from 2017, where they basically made 10 million. And the company, again, if we take a look at the metrics tab, you will see here that it's valued at 1 billion. And so it's making 10 million back in 2017 and then nothing after that. So it's losing money after that. So how much is this company worth to you or to an investor? In my view, nothing, frankly. But in terms of a short squeeze and a potential of making money during this kind of activity, pretty much, you could definitely maybe potentially trade this one and do make some money. But in terms of actually buying it and holding for the long run, I definitely wouldn't do this thing. It's very, very risky. You're more than likely going to lose money in this one, even though it's down 82% a year. It's just not making any money. It's really not worth it actually putting money into this for the long run. It's super risky, and I definitely wouldn't go for it. But thank you for watching this one. I hope this was interesting to you. Again, an opportunity which could be an interesting one for some traders around here in our channel. And let me know what are you thinking about Fubo TV, whether you're actually trading this one or potentially even holding it for the long run. And please remember to like the video, that helps a ton. And subscribe if you're not a subscriber already. Of course, this goes without saying. And of course, if you want to get all these amenities here, where you can actually pretty much analyze every stock in the US market and other markets as well, you can actually visit our Patreon page. You can find a link in the description box below this video. Become a patron and get full access to our tool here. And thank you again for being around, guys. See you in the very next video. Bye-bye.